stop for a second. Don't scroll, because what you're watching right now is the exact window where a lot of investors make the same painful mistake. They sell the strongest part of a move right before the next push, higher, begins. Gold just surged aggressively and then snapped back. Silver followed the same script, and if you felt that sudden tightening in your chest, that quiet thought saying, wait, is this the top? Then stay right here, because the answer isn't hiding inside a single candle or a one-day chart. This is one of those weeks where the market performs a sleight of hand, intentional, calculated. And I want to be very clear from the start, the selling you're seeing can be very real and still point people toward the wrong conclusion. Quick note before we go deeper, I'll keep it brief. There's an active effort right now to push out original creators by recycling and repackaging other people's work. If you value what we do here, help protect it by subscribing and dropping a comment with John AG so the platform recognizes that you're supporting the original voice. All right, let's break down what actually happened. We entered the final stretch of January trading with metals behaving like they were strapped to rockets, explosive moves, loud headlines, strong emotions everywhere. And then, almost right on cue, as the calendar rolled into the delivery window for front-month contracts on the main U.S. futures exchange, the market hit the brakes. In the span of 2 trading days, we saw one of those violent up-then-down sequences that makes people question everything they believed just 48 hours earlier. But here's the part most people miss. Markets don't move only on truth. They move on positioning, they move on who's trapped, they move on who needs out, and they move on time. Time matters far more than most people want to admit. And in a moment, I'm going to prove that with 2 historical patterns that investors still refuse to learn from. But first, I want to lock this moment in. I'm recording this on Saturday, January 31st at 9:40 a.m. New York time. Drop a comment telling me when and where you're watching from. I'm always curious just how global this community really is. Now let's talk about why prices can fall hard without the larger trend being broken. When you get a rapid run-up, you attract a very specific type of buyer. Not the long-term stacker, not the industrial user, not the person building a hedge for the next decade. You attract the momentum crowd. The I'll buy it because it's going up crowd. The I saw it on a chart crowd. And that group doesn't have patience. So when momentum pauses, they don't ask, is the thesis still intact? They ask, can I still lock in a profit? And when that question gets asked en masse, sell buttons get smashed. That's profit taking. It's not moral. It's not bearish. It's not even predictive. It's simply what happens when a trade gets crowded. And profit taking can look like the end of the world when you're staring at a single red candle. But zoom out just a little and the narrative starts to change. Now let me give you the first historical lesson. Back in the late 1980s and throughout most of the 1990s, gold lived inside a painfully boring range. It bounced between the low 300s and the upper 300s, not because nothing mattered, but because the market had locked into a rhythm. Traders who understood that rhythm made money repeatedly by buying the bottom of the box and selling the top. Then the box broke. In the late 90s, gold slipped below that range, and once it fell through, it stayed suppressed for years. Here's the critical insight. People who focused only on fair value screamed that gold was cheap, and they were right in the long run. But the short run lasted far longer than most people could emotionally tolerate. That's the part that hurts. Markets can stay wrong for years while behaving completely normally. And if you don't respect that reality, you end up getting shaken out at exactly the wrong moment. Now, lesson number 2. In the early 2010s, after the famous commodity peak, many markets entered prolonged cyclical declines. Not because the long-term story died, not because the world stopped needing metals, but because capital rotated. Leverage was flushed, and the cycle took a breath. That decline lasted years. Then the secular trend returned. The takeaway isn't, it only goes up. The takeaway is that a bullish trend can still include deeply uncomfortable stretches. And when you understand that, the current pullback stops looking like a funeral and starts looking like a shakeout. Now here's the cliffhanger. This pullback wasn't just emotional. It had mechanical fuel behind it. And once you understand that fuel, you'll understand why reversals can happen fast, sometimes faster than the crowd expects. Let's go there. The front-month contract was heading into delivery. That matters because delivery periods force decisions. Shorts have to roll forward or prepare to settle. Longs must choose between taking delivery, closing out, or rolling positions. That rolling process can generate massive bursts of buying or selling that have absolutely nothing to do with inflation opinions or Twitter narratives. Here's what happens. Shorts buy back the expiring contract and sell a later month. That's a roll. When many shorts do this simultaneously, prices can surge violently. Once that wave passes, prices can sag. Not because the bull market ended, but because the urgent buying is finished. The calendar event ended, not the trend. Think of it like a stadium entrance. When 10,000 people rush through the same gate at once, it feels chaotic. Once they're inside, the pressure disappears. The stadium didn't collapse. The gate just isn't crowded anymore. That's rolling pressure. Now, some people hear delivery and imagine trucks backing up to vaults like a movie scene. That's not how most of this works. Well, much of what's called delivery is simply a transfer of claims within the system. Paper changes hands, warrants change hands. The metal itself might not move an inch. That's why delivery windows can create fireworks in price even while the physical world appears calm, and why the physical market can be tight while the paper market looks liquid. But here's the risk. When the paper market gets overconfident, it forgets the limits of the physical world. That's when you get those sudden, unexplained spikes that move prices in minutes. So when you saw that front month high print, part of that move was the market realizing that promises were coming due. And once delivery notices go out, another strange dynamic kicks in. Some longs don't want the hassle, some shorts don't want exposure, so the same bars can be delivered, resold, and delivered again, all on paper. It's a financial hot potato. That's why you can see large delivery numbers early in the month that later appear to shrink. It's recycling, not conspiracy. And yes, it's complicated. That's exactly why people get tricked. They compress complexity into a lazy conclusion. Price fell, so the story is over. Here's the smarter framework. Once forced rolling ends, what remains is the organic bid. That's the buyer who wants exposure, not because the calendar demands it, but because they believe in the position. That bid doesn't always appear immediately, but when it does, it can feel like the market flips without warning. So what do we watch? We watch whether dips get bought quickly or bleed all day. We watch whether forward contracts stay supported. We watch physical premiums, dealer backlogs, wholesale tightness, and we watch broader risk assets. Because when equities wobble, demand for protection wakes up. Now here's the second cliffhanger. Markets can bounce while headlines remain terrifying. Sometimes all it takes is sellers being done. Once sellers are exhausted, buyers don't need a reason. They just need a price. That's why these moments matter. Blink and you miss the turn. If you watched recent intraday highs, you saw that stampede in real time. Records printed, then prices pulled back. People called it panic. Much of it was positioning. When front month open interest collapses, it tells you the market already made a decision. The roll happened. The urgency is gone. What comes next depends on who remains. Weak hands? The drop continues. Strong hands? The drop becomes a launch pad, and right now signs point more toward the second scenario. Because the problems driving interest in metals didn't disappear in 2 trading sessions. Now let's talk politics. Briefly, but honestly. We watched lawmakers flirt with shutdown drama and then pull back at the last moment. Markets love, crisis averted for about 5 minutes. Then reality sets in. Delays, patches, more spending. Short-term relief is real. Long-term incentives don't change. Add to that the uncertainty around central bank leadership. Even rumors of leadership changes alter expectations. Policy credibility isn't restored by one appointment. It's earned slowly and lost quickly. And if the market senses policy becoming a tool, the risk premium grows. It doesn't vanish. So when you saw the currency bounce, understand what you were really watching. Crowded bets being unwound, not stability being restored. And yes, geopolitical risk remains unresolved. Naval deployments, threats, posturing. You don't need to be an expert to know the reaction. Protect the downside. That's why jewelry demand and small bar buying rise before confirmation arrives. Markets price the next surprise, not permanent peace, and surprise risk remains elevated. Before I go deeper, quick reminder, check the description. I've placed bonus links there, including access to the premium WhatsApp channel and membership options for those who want deeper analysis without the noise. Back to the market. We're seeing risk-on relief and risk-off fear wrestling each other. One headline cools panic. Another reignites it. And here's the uncomfortable truth. The same headline can be bullish and bearish at the same time. A last-minute deal avoids collapse, but signals more can kicking. Short-term currency bounce. Short-term metal dip. Then digestion happens, and the longer-term bid reappears. That's why one-day reactions aren't verdicts. Now about the dollar. Short-term strength doesn't negate long-term weakness. Currencies can bounce inside broader downtrends, especially when measured against real-world necessities like energy, food, housing, and hard assets. This choppy environment punishes leverage and rewards patience. Which brings us to a key question. Are you watching this as a trader or as an investor? Because traders must respect volatility. Investors can use it. Even deep pullbacks can exist inside rising structures. That's math, not opinion. Now silver. Silver is where drama lives. Half money, half industrial. All emotion. Silver sprints, trips, then sprints again. Industrial demand doesn't care about today's chart. Solar, electrification, data centers, medical tech all rely on silver's properties. Supply doesn't adjust easily. Much of it is a byproduct of other mining. That mismatch builds tightness quietly. Add investors on top, and volatility explodes. ETF flows exaggerate moves. Easy entry, easy exit. Selling during volatility often leads to buying back higher. That's the trap. So I'll ask you, are you more bullish on gold or silver from here, and why? Drop real reasoning in the comments. Silver's next delivery window is still ahead. Open interest remains sensitive. That's risk, an opportunity. Now bonds. Yes, auctions get covered. Yes, backstops exist. But coverage doesn't equal purchasing power preservation. That's the deeper question. And finally, what next? A rebound wouldn't surprise me. Neither would a messy consolidation later. This is the environment where positions are built, not celebrated. So here's the mental model. 2 games are happening. Short-term noise, long-term structure. Decide which one you're playing. Don't let one-day candles bully you. Size risk properly. And keep learning. Because the market won't get kinder. Drop your thoughts in the comments. Share success stories. That's how we build a winning community. This pullback looks like profit-taking and calendar mechanics, not the death of a trend. Could prices go lower? Always possible. But the reasons people bought haven't disappeared. Don't get hypnotized by drama. Get disciplined. Subscribe if you haven't. You'll want the next update. Take care of yourself. Take care of each other. And I'll see you in the next one.